Right now, we're living in two economies at once. One is thriving, driven by rising asset prices, while the other is straining under the weight of high costs and growing debt. Hi, I'm Jason Hunsucker, CEO and Senior Advisor at Sequoia Advisor Group, and this is your weekly market update. The Federal Reserve may cut interest rates in December, and in fact, Polymarket is currently showing a 75% chance that that will happen. And a rate cut could help borrowers, but it will not solve the deeper divide that we're seeing in the data. Tech stocks took a step back this week, even after blockbuster earnings from NVIDIA. And AI-driven companies led much of this year's gains, but now investors are recalibrating. Meanwhile, consumer spending is slowing even during the holidays, and delinquencies on auto loans and credit cards are hitting decade highs. So what does this mean for you? Volatility isn't a sign that something's broken necessarily. It's a normal part of healthy markets. These shifts reset expectations and remind us that progress doesn't happen in a straight line. At Sequoia, we don't build portfolios based on fads or formulas. We build for you, for your goals, for your time horizon, and for your plan. That's why we focus on creating resilient, all-weather portfolios that can adapt as the world changes. So here's this week's insight. Prosperity that only lifts a few is not sustainable. True growth comes when everyday families have the power to participate. That's the engine of a healthy economy. And when it weakens, markets grow more fragile. And we're paying attention. This volatility is already informing how we're thinking about positioning portfolios as we head toward the end of 2025 and into 2026. So we'll keep watching and we'll keep working and we'll keep you informed.